Japan's drastic measures are sending shockwaves through global markets. The Bank of Japan's decision to sell off US Treasury holdings aims to stabilize the yen, which has plummeted to historic lows against the US dollar. The stark contrast between Japan's ultra-low interest rates and the US Federal Reserve's aggressive hikes has weakened the yen, prompting strategic financial maneuvers. Japan's plan to sell US Treasury holdings is a bold strategy. Recently, Japan institutional investors has offloaded around $60 billion worth of US Treasuries, influenced by the yen's sharp decline and the need to mitigate financial risks associated with the widening interest rate gap between Japan and the US. Norinchokin Bank's announcement to liquidate $63 billion in US and European treasuries is a significant part of this effort. This move reflects a broader strategy to mitigate financial risks associated with the weakening yen and divergent monetary policies between Japan and the US. If you find this information crucial, like and share this video to spread awareness about these significant global financial changes. Let's see what are the reasons behind selling US debt. The decision to sell US Treasury holdings stems from substantial unrealized losses on bond portfolios. Selling some US Treasuries helps reduce interest rate risk and allows diversification into different assets. This strategic liquidation aims to manage a net loss of 1.5 trillion yen for the fiscal year. The Japanese yen has been under immense pressure, reaching a 34-year low against the US dollar. To top up the yen, Japan's Ministry of Finance has intervened in the foreign exchange market, often selling dollar-denominated assets like US Treasuries to buy yen. This intervention is crucial to prevent further depreciation of the yen, which would otherwise increase the cost of imports and contribute to inflation. Recent actions by the Ministry of Finance to intervene in the currency market, including an unprecedented level of spending to purchase yen and sell dollars, highlight the severity of the situation. Japan's end to its long-standing negative interest rate policy is shifting investment preferences. Rising domestic interest rates make Japanese government bonds more attractive to local investors compared to US Treasuries. This shift reduces the incentive for Japanese investors to hold foreign bonds, allowing them to achieve better returns domestically without taking on currency risk. Recent data indicates a surge in demand for domestic bonds as investors seek to capitalize on more favorable yields offered by Japanese government securities. Japan's decision to sell off US Treasury holdings could have far-reaching implications for the US dollar and contribute to the broader trend of dollarization. As Japan sells these securities, yields could increase due to falling bond prices, making US debt more expensive to service and potentially reducing the dollar's attractiveness as a reserve currency. What do you think about Japan's strategy and its potential impacts? Share your thoughts in the comments below. We'd love to hear from you. Japan's move aligns with a broader trend where countries are reducing their reliance on the US dollar for international trade and reserves. Geopolitical factors such as US sanctions have accelerated this trend, prompting nations to use alternative currencies like the Chinese yuan in bilateral trade agreements. Additionally, the BRICS nations have been increasingly vocal about creating a new international reserve currency to challenge the US dollar's dominance. What are the impacts on the US and EU economies? If Japan proceeds with selling its holdings of US and EU treasuries, several significant impacts on the financial markets of both regions are likely. Selling a substantial portion of US treasuries would likely lead to increased yields. Bond prices and yields move inversely. A sell-off would drive prices down and yields up. This could lead to higher borrowing costs for consumers and businesses, potentially slowing economic growth. A large-scale liquidation of US Treasuries by Japan could introduce significant volatility into the bond market, affecting related markets including equities and foreign exchange. The volatility could be exacerbated by a lack of liquidity in the market as major financial institutions adjust their portfolios in response to the sell-off. Higher yields on US Treasuries would translate into increased borrowing costs for the US government, potentially impacting fiscal policies and overall economic conditions. This could lead to a larger portion of federal budget being allocated to interest payments, leaving less room for other expenditures such as infrastructure, education, and defense. As US yields rise, the attractiveness of US debt for international investors might increase, potentially leading to shifts in capital flows and currency value. This could cause significant adjustment in global financial markets as investors reallocate their assets in response to changing yields and risks. Selling EU Treasuries by Japan would likely have similar impact to those in the US market, leading to higher yields, increased borrowing costs, and market volatility. The European Central Bank's efforts to combat inflation through tighter monetary policy have already pushed EU bond yields higher, and additional sales by Japan could further strain the market. Let's analyze the impact of the US presidential election. The upcoming US presidential election, featuring Vice President Kamala Harris and former President Donald Trump, could significantly impact trade relations between the US and Japan due to their differing trade policies. If re-elected, Trump is likely to continue his protectionist approach, which could strain trade relations with Japan and potentially disrupt Japanese exports to the US. Trump's emphasis on bilateral trade agreements and tariffs could lead to increased tensions between the two countries. Kamala Harris is expected to adopt a more multilateral and cooperative trade approach, promoting free trade agreements and reducing trade barriers, potentially enhancing trade relations with Japan. Harris's policy are likely to focus on rebuilding alliances and engaging in multilateral trade agreements, emphasizing the importance of strategic partnerships. Japan's recent actions, including sale of US Treasury holdings and shifting investment preferences, have significant implications for global financial markets. These moves are driven by the need to stabilize the yen, manage financial risks, and support economic stability. The broader trend of reducing reliance on the US dollar, combined with geopolitical factors, further complicates the financial landscape. The potential impacts on the US and EU economies underscore the interconnectedness of global markets and the importance of strategic financial decisions. Additionally, the upcoming US presidential election could shape the future trade relations between US and Japan, adding another layer of complexity to the economic outlook. As these events unfold, closely monitoring their developments will be crucial for understanding their full impact on global financial stability. If you found this analysis insightful, please like, subscribe, and ring the notification bell to stay updated with our latest content. Stay safe. Thanks for watching.